You bought Bitcoin at $73,000. You checked the chart before sleeping. The candle was green. The comments were confident. The thumbnails said breakout. Then you went to bed. 6 hours later, you woke up. Bitcoin was down 13%. No announcement, no clear news, no warning. Just a red number on your screen. Your profit was gone. Your phone was full of panic. Telegram was blaming whales. X was blaming the Fed. YouTube was blaming manipulation. The exchange showed liquidations everywhere. You called it a crash. They called it a plan. More hidden systems every week. Hit the bell. Bitcoin looks simple from the outside. You buy, you hold, you sell. The price moves. That is what retail investors see. But behind the chart is another market. A colder market. A faster market. A market built from wallets, funds, leverage, algorithms, and fear. You think Bitcoin drops because people suddenly change their minds. Sometimes they do. But most crashes are not one decision. They are chains of forced reactions. One wallet moves. One fund redeems. One leveraged trade breaks. One rumor spreads. One macro headline hits. Then the system starts selling into itself. This is why Bitcoin can fall without warning. Not because nothing happened, because the important things happened below the surface. The first layer is the whale layer. Whales are massive Bitcoin holders. They hold enough coins to move the market. Not by magic, by size. There are roughly 1,279 large Bitcoin entities. Each holds more than 1,000 Bitcoin. That is not a normal portfolio. That is a market weapon. In 1 week, 6 large holders disappeared. That means at least 6,000 Bitcoin changed hands. At $73,000 each, that is enormous. Roughly $440 million left whale wallets. You may see one red candle. Professionals see wallet movement. When a whale sends Bitcoin to an exchange, it usually means one thing. They are preparing to sell. Coins sitting in cold storage are patient. Coins moved to exchanges are different. They are liquid. They are ready. They are near the exit. When one whale sells, price can fall. When price falls, smaller investors panic. Then smaller investors sell too. That is not random. That is the mechanism. A whale does not need to sell everything. They only need to start the move. The crowd finishes it for them. You see panic. They see liquidity. You see a crash. They see available buyers. And in markets, available buyers are the exit door. The second layer is the ETF layer. This is newer, and it is powerful. Spot Bitcoin ETFs changed the entire structure. They made Bitcoin easier to buy. They also made Bitcoin easier to sell. That second part matters more during crashes. Spot Bitcoin ETFs now hold massive Bitcoin reserves. Some estimates put them near 6% of total supply. That sounds bullish during inflows. It becomes dangerous during outflows. Because an ETF is not a person. It does not believe in Bitcoin. It does not have diamond hands. It follows instructions. If investors sell ETF shares, the fund must respond. Authorized participants redeem shares. Bitcoin leaves the structure. Actual coins can hit the market. The selling becomes mechanical. No emotion, no debate, no conviction, just flows. In late May, ETF outflows became heavy. Reports showed billions leaving Bitcoin ETF products. For days, redemptions kept coming. Over 40,000 Bitcoin left fund structures. That is about $3 billion. Imagine $3 billion in Bitcoin needing liquidity. Now imagine that happening while retail is already nervous. Nobody needs to announce a crash. The pipes create one. That is the hidden ETF mechanic. The same door that brought institutions in can also let them leave quickly. Retail calls it fear. Funds call it redemptions. The chart calls it selling pressure. The third layer is leverage. This is where small drops become violent. Many Bitcoin traders do not just buy Bitcoin. They borrow money to buy more. That is leveraged trading. A trader may have $1,000, but they trade like they have 10,000 or 20,000 or more. When price rises, gains look bigger. When price falls, losses explode. The exchange does not wait for permission. It closes positions automatically. This is called liquidation. Liquidation is forced selling. The trader does not choose. The platform chooses. The system sells to protect the loan. Now imagine thousands of traders doing this together. Bitcoin drops slightly. Some long positions liquidate. That selling pushes Bitcoin lower. Then more positions liquidate. That pushes it lower again. Then more positions break. The crash starts feeding itself. On May 28th, Bitcoin broke below $73,000. Within hours, nearly $1 billion got liquidated. Bitcoin positions alone made up hundreds of millions. Roughly $386 million vanished from Bitcoin trades. That is not normal selling. That is automatic selling. The difference matters. A normal seller can hesitate. A liquidation engine cannot. It does not care about support levels. It does not care about long-term belief. It does not care about your average entry. It only sees collateral. Then it closes the trade. This is how one drop becomes 10 drops. Because leverage turns price into a trigger, and triggers do not ask questions. The fourth layer is sentiment. This layer is invisible, but it can move billions. Crypto runs on narrative. Bitcoin is digital gold. Bitcoin is scarce. Bitcoin is institutional. Bitcoin is untouchable. Bitcoin is never sold by true believers. Then one signal changes the mood. Strategy became one of Bitcoin's biggest corporate symbols. For years, the message was simple. They buy, they hold, they do not sell. That position became more than a balance sheet. It became a signal that conviction was stronger than volatility. Then came the sale. Strategy sold 32 Bitcoin. Not thousands, not millions. 32 coins. About $2.5 million. In normal finance, that number is small. In narrative finance, it was huge. Because the sale was not about size. It was about meaning. If the loudest holder can sell, what else can change? If the never sell story bends, what else is fragile? The market did not react to 32 coins. It reacted to a cracked story. That is how sentiment works. Small facts become large symbols. Large symbols become selling pressure. Selling pressure becomes a chart. Then everyone pretends the chart explains everything. It does not. The fifth layer is macro. Bitcoin was supposed to escape traditional finance. It did not. Bitcoin trades like a risk asset. When liquidity is loose, Bitcoin rises. When liquidity tightens, Bitcoin struggles. When the Fed sounds hawkish, Bitcoin falls. When yields rise, Bitcoin falls. When the dollar strengthens, Bitcoin often falls. When geopolitical fear rises, Bitcoin often falls. That surprises many people. They expected Bitcoin to behave like protection. But institutions often treat Bitcoin like risk. When fear hits globally, they sell risk first. Tech stocks, growth stocks, crypto. Bitcoin is usually near the front. During military tension, traders reduce exposure. They close leveraged positions. They raise cash. They sell volatile assets. In 2026, military strikes increased global fear. Crypto saw massive forced liquidations in one day. Roughly $1.83 billion got liquidated. That was not only about Bitcoin, but Bitcoin led the emotional reaction, because it is the symbol. When Bitcoin turns red, the whole market notices. This is the uncomfortable truth. Bitcoin can be independent in theory, but traded like NASDAQ in practice. The code may be decentralized. The liquidity is not. The ownership is not. The ETF flows are not. The leverage is not. The emotions are not. That is the hidden layer. Most retail investors think price means supply and demand. That is true, but not their supply and demand. You bought Bitcoin. You are not the market. The market is whale wallets. The market is exchange order books. The market is BlackRock ETF flows. The market is Fidelity ETF flows. The market is hedge funds using borrowed money. The market is offshore derivatives desks. The market is liquidation engines running all night. The market is algorithms scanning headlines. The market is traders hunting stop losses. The market is market makers widening spreads. The market is panic becoming liquidity. You are not playing the same game. You are playing on the same chart. That is different. You see price. They see positioning. You see support. They see liquidation clusters. You see resistance. They see resting orders. You see a dip. They see exit liquidity. You think the market is reacting. Often the market is being triggered. This does not mean every drop is manipulation. That is too simple. The truth is colder. The structure creates predictable weakness. Whales know where liquidity sits. Funds know redemption pressure. Exchanges know liquidation levels. Algorithms know emotional zones. Retail usually knows only price. That is the imbalance. And markets punish imbalance. Now here is what this means. This is not financial advice. It is a framework. First, the drop you saw was probably prepared. Not by one person. Not in one room. Not with one button. Prepared by the structure itself. Whales moved first. ETF flows added pressure. Leverage turned pressure into speed. Sentiment turned speed into fear. Macro turned fear into selling. Then retail arrived late. Second, leverage is the accelerant. Without leverage, drops can be slow. With leverage, drops become avalanches. A 5% move hits stop losses. Then liquidations hit the book. Then forced selling creates more selling. Then the chart scares everyone else. Leverage turns normal volatility into violence. That is why Bitcoin crashes feel vertical. They are not only human reactions, they are machine reactions. Third, sentiment moves faster than fundamentals. Bitcoin did not change because 32 coins were sold. The network did not break. The supply cap did not change. The code did not change. But the story changed. And in crypto, perception is price. A rumor can move faster than a balance sheet. A wallet transfer can move faster than earnings. A headline can move faster than analysis. By the time you understand the story, the trade already moved. That is why retail investors feel late. They are not slow. They are downstream. The whale moved. The ETF redeemed. The leverage broke. The story cracked. The macro headline hit. Then your phone notified you. That order matters. It explains the feeling. You wake up after the crash, because the crash began before your screen refreshed. Have you ever panic sold Bitcoin, only to watch it recover the next day? Tell us in the comments. What price did you sell at? And what did the market do afterward? Because that moment teaches the hidden lesson. Bitcoin does not only test conviction, it tests awareness. It tests whether you understand the machine. Most people only see the candle, but the candle is the last image. Before that, there was wallet movement. Before that, there were ETF flows. Before that, there was leverage. Before that, there was sentiment. Before that, there was macro pressure. The chart is not the cause. The chart is the receipt. Next time, we follow another hidden system. The machine behind market narratives. How headlines move money before facts arrive. Because in modern markets, information is not neutral. It is ammunition.